Hi, everyone. This is Jason Barrick of Wall Street from Main Street.
And Lee Josto from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 21. Lee, we are recording this show because it's Finance Unspun, not an interview, on Sunday night, June 18th, 2023. Lots of crazy stuff has happened in the last couple of weeks. We've had I would call it an absurd stock market rally, but anyone who's looking at just technical charts and trading is calling this a new bull market.
It's really just the term based on percentage moves of the market itself. But to me, I said to expect it. It came. I said maybe a week or so ago that it's getting long in the tooth. You really got to be careful here. I'm sorry, especially when we're going to get into some fundamentals tonight, and you really got to think twice before you throw money at a stock long.
And the valuation on stocks like Nvidia, and you just have a bunch of people now piling into that stock. I mean, day trader, short-term swing traders, no one's talking about the fundamentals. It's all about the chart and price action. So people are buying high and selling higher. So at some point, it's going to run out of steam. There's not going to be as many buyers. I mean, what isn't the market cap over $1 trillion already? And it's just had an absolutely big move already. So I'm not saying Nvidia doesn't have long-term potential. It's just that the valuation on this thing is absurd. And if you talk to a short-term trader, they'll tell you it's going to keep going up and up and up. And in the short term, it might go up a little higher. But the way things work with a lot of these markets and cycles, the higher this thing goes up at a faster angle in the short term, the higher the probability is that, I don't know, a couple months from now, it's going to, the old Wall Street saying is it goes up like an escalator and down like an elevator.
Yep, no doubt about it. Yeah, we were talking a little bit about the VIX too, which is just continues to trade lower and lower, and the lower that goes, the more risky the market gets.
I would totally agree. I think the analogy here is kind of how an earthquake occurs right near the coastline, and you start to see the tide go out. The ocean water starts to go out, and the beach is empty. There's no water there, and you're like, everything is calm and serene. But when in the past, when we've seen the VIX go this low, and it may stay this low for a few months, but if you go back on a long-term chart of the VIX, every time it gets this low and capped this low in the 12, 13 range, somewhere around there, it stays for a couple months, and then it has a big spike and blows up and just causes immense damage. I think we're heading towards that way, maybe, Lee, because we're in the summer here, kind of summer doldrums historically. The old saying on Wall Street is sell in May, go away, come back after Labor Day. I think we're looking at a lot of problems potentially after Labor Day in September or October. I think the probability, especially if the Fed decides that they want to raise interest rates 2 more times, because the Fed is, as of now, and I mean, the Fed could easily change things quickly, but as of now, the plan is to raise interest rates twice more, I guess quarter point hikes, although there's some radicals saying higher than quarter point hikes before the year ends.
The whole Fed situation just baffles my mind, because so much of the inflation that we've experienced the past few years, and yes, I mean, there's obviously an impact of like excess liquidity in the system, but so much of the inflation we've seen has been supply chain issues. And I'm sorry, rate hikes are not going to fix supply chain issues.
Well, the deflationistas have blamed the inflation issues not on temporary supply chain, but also on commodity prices. And they're saying now that oil and these other energy prices are down, the inflation is dead. But people should really go back and look at the money supply growth. So the U.S., the Austrian true money supply, which you can look up the definition of that on the Mises Institute website, the Austrian true money supply was up 160% money supply increase from 2009 to 2019, and then it increased by another about 50%, according to one hedge fund manager.
I was going to say they spiked the heck out of it at the beginning of COVID.
From 2020, correct. So from 2020 to 2022, and this is just the US. This is just the Federal Reserve Bank. Yep. It's not counting the global macro hedge fund guys and the people tracking the Austrian true money supply are not tracking all the central banks together. So if you counted if you actually looked up all the different central banks using this, I mean, it was many trillions that flooded the markets in basically 2.5 years in 2020, 2022. Now they've started to, some of these other central banks have also started to raise rates, but they're not raising as fast as the Fed. So the Fed if you look at a lot of macro experts right now, they're talking about liquidity drain, Fed's reducing their official balance sheet, with the Treasury General account being refilled soon. I think the refill starts this week coming up. So a lot of people are predicting the liquidity drain as the U.S. Treasury refills the Treasury General account, starts to sell more Treasury bonds that will pull more liquidity out of the market. What they're not seeing, the other side of this picture, because we focus on global macro, is that the other countries, these other central banks, have not been as aggressive as the Federal Reserve Bank has with raising interest rates, with reducing the balance sheet. And so you've seen, there was a chart my friend Daniel Lacaille put out. He's a money manager and also an Austrian school economist and writes for Mises. And he showed that the global money supply is around the 2022 highs, but it's not because of the Federal Reserve Bank necessarily, because the Fed's been very aggressive recently for the last 12 plus months. It's the other central banks that are actually being more lax, more adding liquidity to the system, or potentially doing easing. I mean, one of those is China, where the Chinese yuan is down to, I think, 7 point. There's basically a devaluation with the Chinese yuan, 7.3 Chinese yuan to the dollar. And my friend, hedge fund manager Brian McCarthy, who is a China hedge fund manager, tracks China data daily. He thinks it's going to end up 7.5 Chinese yuan to the dollar, potentially by the end of the year, if not sooner.
Wow. And I know we've talked in the past about the Bank of Japan craziness. So they certainly have not been tightening down on credit. No.
And Lee, what this does too, and this is probably why we've had kind of a shocking stock market rally, is it creates kind of a mini dollar milkshake. I wouldn't call it the full dollar milkshake, because the full dollar milkshake, in my opinion, and Brent Johnson's a really smart guy. I'm friends with him. I've interviewed him in the past many times over the years in the archives of the Wall Street for Main Street YouTube channel. But the dollar milkshake, a lot of the premise of it is that all this capital is going to come back and buy U.S. assets and keep the dollar strong. Well, I think a lot of that occurred from 2009 to 2019 as foreigners were buying up a lot of home prices, a lot of residential real estate here in the U.S., across the entire U.S. And there's almost a perfect correlation, according to Yardini research, with the top 6 or 7 central banks expanding their balance sheet and the S&P 500. So a lot of that liquidity and capital ended up here in U.S. capital markets, in U.S. real estate and U.S. stocks. But with the other countries injecting liquidity recently, and the U.S. being aggressive with rate hikes and reducing the balance sheet at the Federal Reserve, that's kind of created, I guess, like an aftershock, a mini dollar milkshake, where that liquidity in those other countries from less aggressive rate hikes and other policies, that liquidity has ended up back in U.S. stocks again.
And hence the market has rallied for the past few weeks. But I mentioned to you just a few minutes ago, I was looking at Yahoo Finance, and I think they had one of the best headlines of any article I've ever read. And it was talking about, making a comment about the breadth of the market move. And it said the headline was, the S&P 493 is finally joining the S&P 500's rally. So basically, we've had this huge run up, but it's been concentrated in just a few stocks, which is not a healthy way for the market to move.
And I think the stocks that were shorted the most were like the small caps. So a lot of them are regional banks, and those have had a rally in the last 10 days or so. And then also a lot of the other S&P 500 stocks in the past week. But I don't think these rallies are sustainable. If you look at the conference calls and the earnings warnings from a lot of these companies, there's just a ton of fundamental evidence, especially the consumer stuff, with the credit card debt, the interest rates, the demand for mortgages, the consumers tapped out. There's tons of, whether it's electronic stores with big ticket items and appliance companies, department stores, clothing companies, just discounting, clear inventory. The consumer seems to be with $1 trillion in credit card debt, savings being tapped out, savings being drained right now because of 2.5 years of really bad stagflation, shrinkflation, and tax increases. I think there's a lot of evidence, Lee, that a lot of these consumer discretionary companies, their consumers are tapped out or trading down for cheaper things.
Well, when you start drilling down into what's going on in the economy, there's tidal waves coming right now. We have not only the consumer debt, demand for housing is just fallen off a cliff, mostly because the interest rates have gone so high. But we have the student loan repayments have to be made. We've had this moratorium since COVID, basically. That's coming to an end now. And then on top of that, commercial real estate there's been so many companies that have been in long-term leases and they've just been paying them, but those are coming to an end. And I can't imagine there's a company in the whole country that's going to be keeping the office space that they've had previously because people are not going into the office. I mean, yeah, I know some have returned to work, but it's not like it was in 2019 and before.
And we're getting warnings in the last week or so from the CEO of Goldman Sachs about write-downs for commercial real estate and the chief financial officer for Wells Fargo, that they have immense write-downs on their commercial real estate loan portfolios coming. So we're seeing just daily headlines, bad news, commercial real estate. Either the owner of the building that had a mortgage, the cash flows aren't there, and the owner of the building just said, we're handing the building back to the banks. We're starting to see that. We're starting to see these commercial real estate funds, they're closing, so investors can't flee. I think the largest hotel in downtown San Francisco, that one was handed back to the lender. So there's just red flag. And then, of course, like a lot of these bricks and mortar retailers and the restaurants that are kind of the main ones of these shopping malls or other commercial real estate, they're closing locations like crazy too. So there's a lot of red flags there, but we haven't seen that affect a lot of the banks yet in a bad way. So Lee, really, this reminds me, and I think this cycle is different from 2005, 6, 7, in that I think the major bust here is going to be probably the worst U.S. commercial real estate bust in 80 to 100 years. And that last cycle was with residential real estate. But I also think there's a lot of similarities between what's happening right now, the calm before the storm, and what happened in 2005, 2006, and 2007, where we were starting to see all these headlines, but we hadn't seen any major banks fail.
You know, I read an article, it was on Market Insider, and it quotes Fred Cordova, who's the CEO of Corient Enterprises. And he basically said that the warnings issued by Goldman and Morgan have come too late, and office prices are already in a free fall. And he's basically saying the commercial real estate is going to be a cataclysmic crash, and it's already underway. And this article was from the beginning of the month, just a couple of weeks ago. So I can't imagine things have gotten any better since he wrote that, you know?
But no major failures yet of any other regional banks. So things have been calm for over 6 weeks now. It's been almost 2 months, I think, since First Republic Bank. Yeah, it's been a while since we've had murmurings of any major failures at a regional bank.
You know, interestingly, I saw an article today that they were promoting the fact to buy regional bank stock. And I'm thinking to myself, okay, someone's trying to unload their positions. They want to sell out. That's the only time they run stories like that in the financial press.
Well, let's be really honest. A lot of these regional banks all need to do equity capital raises. Here's the problem. And I had a conversation with that same banker that was telling me all the problems at a large bank. This banker off the record who tweets anonymously, but he was telling me of all the problems with the regional banks. So they have losses on their older bonds. They have much higher depositor fees. They didn't have modeled that they would have a higher 5% or higher cost of capital. So their net interest margins are screwed up. The banks, according to the most conservative bank stock analyst on Wall Street, Christopher Whalen, and he has free articles on his blog website about this, and he's done public interviews on Bloomberg Radio and elsewhere. He says that the banking system is basically insolvent. And that's even according to the FDIC reports. The banking system is sitting on at least $5 trillion in losses. If that is true, a lot of these regional banks need to do immediate equity capital raises. They need to sell tens of billions of dollars in new shares. And my conversations with this banker, what the banker basically said is maybe one of the regional banks can get one equity capital raise done with the rally here we've had in regional bank shares, the small caps, in the next couple of weeks. Maybe one regional bank gets the 10 billion or 20 billion or something like that equity capital raise. But as soon as the market sees that, all the other investors and market participants, especially short sellers, because a lot of people were shorting these regional banks, they're going to pile into the other regional banks again and bet that the other regional banks are going to try to do capital raises. And those other regional bank shares are going to get hammered down a lot, say 10, 15, 20% very, very quickly before they can get their new equity capital raises done. So he said maybe one will do that, but then it will send a signal to the market that the rest of them aren't going to be able to get the equity capital raises done.
I can't imagine it's going to improve anytime soon for these regional banks. There's really nothing out there to drive profit for them.
Not especially if their loan book is I mean at these interest rates. So the consumer, a lot of small business, if you're a small business owner, you're dealing with higher interest rates. Potentially your landlord may be raising your rent costs, which you don't want to do. So you're looking at either downsizing or closing locations. If you're a small business owner right now and you're dealing with higher interest rates and less consumer demand, if you have a consumer discretionary business, it's a nightmare out there right
Yep.
now, because a lot of these regional banks are not going to be growing the loan book. I mean, they probably shouldn't, especially at these interest rates, but they're going to be hankering down a lot into bunker mode. It'll be interesting to see which ones go next. It looks like Zion's Bank, from from the articles I read, the Bloomberg ones, it looks like there's red flags there. But I think even those shares have rallied lately. So
Yeah, but I mean, you can't, like we were talking about before we got on the air. You can't really look at moves right now in terms of like longer term economic stuff, because it just takes so long for things to unfold and show an impact in the markets.
Well, we were discussing this before we started recording, and let's just compare things with the last real estate cycle and bank bust, is how things played out 2005, 6, 7, and 8. So you had 2005, 6, 7. It was obvious there were problems with all the mortgage-backed securities, with subprime, all the stuff tied to subprime. It just took a while. So it took 2.5 years, I think, from 2005 to 2007 before you started to see immense cracks. And at first, it was only a couple real estate hedge funds in Bear Stearns that had the problem. But Bear Stearns was leveraged, I think, 60-1, and Lehman Brothers was leveraged 40-1 on their balance sheet. And then eventually, I think within a short amount of, once the crack started, I think it took another 12 months from 2007 to 2008 before Bear Stearns failed. Or is that correct? Or was it Lehman Brothers in 2008? But it didn't happen right away, though. So it took over 6 months for the hedge funds at Bear Stearns failing, and then it played out. There was a rally. So there were rallies along the way.
Oh, no doubt about it. I think it was.
Well, you had idiots like Jim Cramer, or shills like Jim Cramer, saying that Bear Stearns was a good buy, even though like their hedge funds were cracking and all the bears were warning people, and he was still recommending stocks like that.
Right. No, I understand. Bear Stearns collapsed, I think in 2008 they collapsed. So it certainly was a while afterwards. You know, I watched a very interesting interview on Stanley Druckenmiller, and he was talking about the Fed balance sheet, and he said that Yellen drew down Treasury General account $700 billion to practically nothing, which was a big boost to the market liquidity. But she recently stated that she wants to build back it to normal levels, which would mean 700 to 800 billion in treasuries issued by year end this year. I wonder what kind of impact that's going to have on the markets.
Well, I mean, if there's going to be no independent Fed audits and the Fed doesn't have to adhere to generally accepted accounting principles, in theory, they can keep raising interest rates, and they can do all kinds of shenanigans off balance sheet, and they can keep the asset markets relatively propped up while they refill the Treasury General account. Now, if they had to adhere to generally accepted accounting principles and they couldn't get away with all these currency swap lines and buying up even this BTF. I'm screwing up the acronyms here. I was thinking of buy the fucking dip. Whatever that alphabet soup program the Fed put in back in February after Silicon Valley Bank. So that's where the bank posts collateral that's worth 70 cents on the dollar or less, and the Fed gives them a loan at 100 cents on the dollar. And the Fed's like, oh, it's a penalty rate, and oh, the bank's going to have to take the assets back in 12 months. But we know from the 2019 repo madness crisis, they said the exact same thing during the last rate hiking cycle. It was not QE initially. The Fed's balance sheet was not supposed to expand. They were loaning at 100 cents on the dollar for bad assets and bad collateral back then too in 2019 during the repo crisis. And then a couple of months later, back then in 2019, the Fed's balance sheet was up $1 trillion in under 3 months.
Here's a quote from Fed Governor Christopher Waller. He said this in Norway at a central bank and international monetary fund conference. I do not support altering the stance of monetary policy over worries of ineffectual management at a few banks. I think that says a lot there.
Well, he's clearly lying. I mean, there was another New York Fed director, Scott Russler or something. I forget the guy's last name. But he actually put out an honest warning because he's a real estate investor. And he actually put out a tweet 4 or 5 months ago, honest warning about the problems in commercial real estate. He said, look, $1.5 trillion in commercial real estate loans has to be paid back or rolled over in the next 3 years or less. And he was like, the cash flows don't support any of this, and it's a mess. And the commercial real estate market is larger than that. So that's just 1.5 trillion just in the next 3 years or so. Well, 2.5 years.
Well, he also said it is the job of bank leaders to deal with interest rate risk, and nearly all bank leaders have done exactly that. Well, I think we'll see that's not true in the next few months. Going back to the Stanley Druckenmiller interview I saw.
Well, the narrative was that the rate hikes would be good for banks.
Well, what Druckenmiller said was the Fed basically convinced all these financial institutions that they would keep rates artificially low until 2024, until they actually started raising rates. So, I tell you, there's just the insanity of the Federal Reserve System just killed.
Well, the cost of capital for a lot of these banks, especially the regional banks, is up over 10x in the last 12 plus months. So their cost of capital is up. These regional banks were not planning on having to compete with US Treasuries at 5% or money market funds at 5%. So the depositor, if you have savings, a lot of these depositors, and they're not thinking about the taxes they have to pay on the money market funds or their US Treasury, their yield. They're not thinking about any of the taxes. They're just seeing that, it's an easy risk, quote unquote, risk-free 5%. And I'm going to put my savings into the money market funds and go directly to the US Treasury website and buy short-term treasuries. But this is still putting immense pressure. So if the Fed raises interest rates more, the short term, they'll invert the yield curve further. And then even more money will leave regional banks and it will go into short-term US Treasuries. So that will put even more pressure on the regional banks. You will have depositors fleeing, taking cash out of checking and savings accounts at regional banks. And they will then take that cash, their savings, and they could do it on their smartphone. So this is the first time in history, we didn't even have this during the last major banking problem and real estate problem in 2008, where the depositor can literally pull out their phone and they can move hundreds of thousands, millions of dollars very, very quickly on their phone from one bank to another, or from one bank account to the US Treasury Direct, and go and buy short-term treasuries. And this is potentially just creating immense problems for the regular banking system. So the narrative.
Could you imagine a conversation on Wall Street bets rushing into treasuries?
But if Lee, the videos you should see the amount of views on the YouTube video saying you can earn. They're getting hundreds of thousands of views right now, saying you can earn a risk-free 5% now. Those videos are getting over 1,000 times more views than any of the stuff we do.
Right, or crypto stuff probably is dead.
But my point though is that this is the Fed is not anticipating any of this as normal. So this may actually, even if this does create more demand for treasuries, it will hurt the private sector. It will crowd out.
Oh, no doubt about it. No doubt about it.
And it will hurt asset prices in the long run. It will hurt a lot of other asset prices.
It's going to hurt a lot more than asset prices. Unfortunately, there's going to be some real pain coming in the future.
Well, it's going to hurt the real economy, and it's going to kill tax revenues, because these companies are going to see the consumers tapped out. Mm-hmm. The companies aren't going to invest. The companies, they have balance sheet problems, especially at higher interest rates, because there's a lot of corporate debt too. The amount of corporate debt has doubled since 2008. So you have, I think it's over 10 trillion in corporate debt now, and now at higher rates, it's gonna a lot of it has to be rolled over at higher rates. So that means less investments in growth, less investments in jobs. And a lot of in this environment, you're going to see, if the consumer's tapped out, you're going to see a lot of companies look to fire humans or reduce their hours at least.
There was an article in Zero Hedge that they said when the restart of student loan payments, I think that happens in September, it's going to slash household spending by $15.8 billion, not per year, but every month. I mean, that is a significant drain to the economy. And it's already on thin ice, as we all know.
Well, here we have very high levels, Lee, and it's much higher than in the past. So since 2020 and all the crazy stuff the Fed and other central banks did, stimmy checks, inflating asset prices, you have very high levels of stagflation, shrinkflation, and now taxes.
Hmm.
So yeah, the official government inflation rate, the CPI is down, but if you go to shadow stats, I mean, we're still, I think, above 10% on the inflation rate. My point, though, with this whole thing with stagflate tax sly is that even if the inflation rate was 3% to 6%, the Fed's been intentionally doing inflation. The US government and the Fed have been intentionally underreporting the inflation rate for a very long time. Even if you only had 3 or 4% inflation rate, and it started in the 1990s, mid to late 1990s or early 2000s. I mean, here we are over 20 years later. That adds up a lot. I mean, that's if you've been investing or trying to run a business, or you retired a long time ago. And my great aunt and my great uncle, before they passed away, I mean, they retired 20 something years ago. And as the Fed was doing these policies starting in 2008, I mean, their standard of living, because they couldn't get good income, risk-free income back then, because the Fed was lowering interest rates to zero, their standard of living just totally collapsed. So they actually ran out of money for their savings for retirement because of all the crazy policies the Fed has done. And then my great uncle, unfortunately, also had hundreds of thousands of dollars in Bear Stearns stock when it crashed.
Oh, I'm sorry to hear that.
Well, he passed away, but they had to do a reverse mortgage. So this is
So
what.
sad.
But this is what the Fed does over longer periods of time.
Yep.
The average person doesn't think about any of these things and the ramifications for that. And even if the real inflation rate is coming down a little bit, I mean, there's still a lot more pain because the commodities, the supply side problems haven't been fixed. And at these interest rates, I don't think anything is sustainable at these interest rates. The Fed's acting like interest rates are going to stay this high for a while, but basically, the more either they keep interest rates at these levels or raise them, they're going to they are going to totally break the banking system, and a lot of the commercial real estate and stuff is going to take a lot of these regional banks down.
Oh, no doubt about it. You know, I can't remember where I saw this, but I saw some chart. It was a few years ago that basically showed the Dow Jones or the S&P 500 adjusted to true inflation, like in, shadow stats, true inflation. And it basically hasn't moved. It's just been a result of money printing,
And it's actually even worse than that, because a lot of these large cap companies, they had cheaper cost of capital while the Fed was lowering interest rates with zero interest rate policy. And you're exactly right. And I've been saying this too. It was a Pavlovian response. The Fed trained investors, so speculators, investors, gamblers, and then large corporations that were publicly traded to keep adding more and more debt to the balance sheet, because either interest rates would go lower or the Fed wasn't going to raise rates. So a lot of these companies just keep adding debt to the balance sheet. And unfortunately, they use this debt, I would say, not productively or efficiently. They did a ton of share buybacks. So they loaded the balance sheet with debt for share buybacks. So the insiders running these companies could offload their shares. And then the share buybacks were happening with debt. So the insiders could cash out of their shares at higher stock prices without the shares crashing.
I mean, it's basically one giant moral hazard created by the Federal Reserve System. That's it in a nutshell, as far as I can see.
Well, and debt-based fiat currencies and fractional reserve banking and the Cantillon effect and stagflate tax law, you add all these things together, and the global financial system is a fiat currency and credit Ponzi scheme. It looks a lot like a Ponzi scheme, because we just keep wondering, how can debt keep growing? How can debt be rolled over and extended? Well, in a higher interest rate environment, that basically, when the Fed, and honestly, we're free market, the Fed shouldn't have control of interest rates because they're arbitrarily pulling these levers. They caused an artificial boom for 15 years, and now they're raising interest rates too quickly, and they're destroying the banks, or a lot of the banks. So like the larger banks like JP Morgan and others are too big to fail, but the other banks, since they're not considered too big to fail, the other banks are in immense trouble.
But let's talk just for a second about this artificial boom. The biggest problem with it is it causes so much malinvestment. So it's stupid investments made by people, and they're basically they're just chasing something. And
it also financializes the economy too. So the companies are not making investments into research and development, property, plant, and equipment. The share prices of the companies are not going up when the company builds a new factory, creates new jobs, a new product or service. That's the opposite. When the company fires people, the shares go up. When the company does share buybacks with debt, loads the balance sheet with cheap debt, the shares go up.
So let's talk about real assets instead of financial engineering. I know you wanted to talk about Einhorn and his big bet on coal and energy.
Well,
And,
Warren Buffett too, because he
and
keeps
Warren
buying
Buffett. Yep.
Occidental Petroleum. Although, I mean, he's not exactly diversifying, so he just keeps making a bigger bet on Occidental Petroleum. I don't know if he plans on buying the whole company and taking it private. I mean, the average investor out there shouldn't bet on just one oil and natural gas company. It's very risky to bet to only own one oil
Oh,
and natural
definitely.
gas company.
No doubt about it. I mean, anything could happen. There could be just financial shenanigans that no one knows about within the company, and all of a sudden, boom. Uh, Heaven knows what will happen. But as far as Einhorn, he's invested in Consol Energy, CNX, and also uh,
Is that an oil company or?
Consol Energy, and he's also invested in CNX Coal.
So
So
that is, for listeners out there, that is very shocking. David Einhorn is a traditional value investor, and normally traditional value investors shy away from commodity companies, so cyclicals, companies that have very high maintenance capital expenditures or capex. So those are your mining companies. They have exposure to commodities. The capex bills could be larger than the cash flows if the commodity price goes down. And so he's looking at valuations on a lot of this stuff and looking at profit margins and cash flows. And here he is, and he's buying coal stocks and he's buying oil stocks and natural gas stocks. It's just pretty shocking what a traditional value investor is doing with capital allocation. I think Stanley Druckenmiller was doing this too, but there are fundamental reasons for this, especially on valuation, because there's a lot of profitable oil and natural gas companies at super cheap valuations, whether you're Suncor up in Canada, I think 6% dividend yield, or a Petrobras in Brazil. There's a lot of American and Canadian ones as well. So just across the board, there's tons of really good valuations on companies with cash flows. You just have to watch out for too much debt and high production costs. But for the fundamentals in the oil market, Lee, we're looking here in the United States, the rig count, which indicates future supply, the rig count is collapsing. A lot of that's because natural gas prices have been so weak. And a lot of these, I interviewed Christine Guerrero, who's a petroleum engineer, and she talked about this in her interview, that a large percentage of the revenues of the Permian Basin wells, which is where almost all of the U.S.'s oil production growth has come from since 2009, a very large percentage of the revenues from those wells are from natural gas. So if the natural gas prices are down, those Permian Basin wells, the economics on those things are not really good. I also just found a really good chart from Statistica that was going through all the oil and natural gas companies publicly traded here in the United States. And I'm not sure if this data is a couple months old or not. I think it came out like end of 2022, early 2023. And it was basically saying that the break-even cost for a lot of U.S. oil production outside of like the Permian Basin is $60 a barrel or more oil. So we're getting dangerously close right now. We're at, let's see here, let me pull up the price. The West Texas Intermediate price is at a little over $71 a barrel. If we go another $10 a barrel lower, a lot of potential new oil wells, new production, totally uneconomic.
yeah, it's interesting. Bloomberg reported Friday that gross short positions in U.S. crude are at a 3-month high. So obviously the traders or the commercial traders
That's
are looking at
I
it.
would argue, Lee, that's a lot of that is global macro hedge fund
Yep.
analysis that's
Yep.
looking at global economy slowing down, deflation, bankruptcies, bank crisis, real estate problems. What they're not looking at actually is on the demand side, the global oil demand. You had record amounts of oil imports by China in May of 2023, the most I think in many, many years. So demand in China starting to come back. The refiners imported a lot of crude oil, and then other demand statistics globally. Shockingly, it's pretty strong on the oil side. So we're close to production costs for a lot of oil, especially if the Saudis. So the Saudis could potentially cut. Global inventories are low. Oil may bounce around these levels, may go a little bit lower. I think if oil goes too much lower, I think the Saudis will cut way more than people expect. Saudis and OPEC will cut. But OPEC production is already starting to fall on its own. I think the Saudis could announce further cuts because honestly, they need a certain level of oil price. They need at least 70, 75, 80 a barrel minimum to fund their governments. A lot of these OPEC countries do, and to fund social program spending commitments that they have.
No, this is a bit tangential, but I think it's appropriate to mention. I think people are waking up to like the whole electric vehicle scam too, and they're starting to realize that they do still need petroleum fueled vehicles in the world. I sent you an article or a video a week or so ago about China and this huge field of electric vehicles that were just sitting there. Did you see that one? Do you remember that?
Yes, there was from ADV China. There's also an article that just came out in the last couple of weeks from BBC talking about the solar panels, how they break down and all the materials that are used, all especially the rare earth elements, because there's thorium byproduct in the mining. There's tons of thorium byproduct, and we don't have any actual real products for the thorium, really. So it has to be stored and it's radioactive. But just to separate out the rare earth elements from each other and to get them into the proper value chain in order to have solar panels or wind turbines, I mean, it's basically toxic. So the air, water, and soil around these rare earth mines is toxic and radioactive, and then you have to store the thorium. So it's just ruining stuff. So to call these things solar and wind renewable is a total joke. I mean, these solar panels, most of them don't even last 10 years.
Yep. And the wind turbines, those blades, they can't do anything with them. They just kind of have to like throw them out. I mean,
well, or the birds fly into them and die because the birds are confused. Or I think now, and I just saw this on Tucker Carlson on Fox News months ago before they got rid of his show, that in New Jersey, they were putting these offshore wind turbines off the beach there, and dolphins and whales were getting screwed up with the sonar beeping systems on the wind turbines, and they were beaching themselves and dying in mass amounts.
Yep. I saw that too. So is there anything else you wanted to cover tonight, Jason?
I think like gold and silver going through a little mini correction. Starting to see a lot of articles about copper. Some people are finally starting to realize that if the government, like the Davos crowd, are going to force people into electric vehicles, that there's not enough copper to switch the internal combustion cars over to electric vehicles. We just don't have enough copper right now to recycle or copper supply. It's just not feasible right now. We need a much higher copper price than the current copper price. So I'm starting to see those articles. But in terms of bargains, I mean, there's a lot of good gold stocks that are cheap right now. I do not like the stuff that Newmont Mining has been doing lately. I just heard. I think
we touched on that last episode.
Well, Barrick tried to buy another copper miner, so that just came out that they attempted a hostile takeover on a copper miner, and it didn't work out. So there's just a lot of head scratching moves from the largest gold miners like Newmont Mining and Barrick that I've never liked those companies for the most part. There was a short amount of time, I think, for Newmont Mining for like 2020, 2021, where they had cheaper oil and energy prices, and they weren't getting involved in like the vaccines and ESG and other stuff. But now they've just had a lot of problems, production problems, cost control problems, CapEx problems at their mines for the last 6 to 8 months, and it's only getting worse. One of their mines, the workers are on strike, Penasquito, down in Mexico, but that mine actually had a lot of production problems over the years. It almost bankrupted Goldcorp. All the problems at that mine over the years that caused the Goldcorp shares to crash, and then Goldcorp sold the company out to Newmont.
Mm-hmm. It's a very complicated sector to follow, gold and silver. I mean,
but I think energy, though, is really interesting right now. Also, the fertilizer and potash companies, because they have cheaper natural gas. But energy, the valuations are cheap. We had a nice rally in the uranium spot price, too.
I was just going to say uranium's probably an area to look at.
Well, the problem, though, is that the U.S. is not going to be able to build a lot of new nuclear power plants. It's just way too expensive, and it's too time consuming, and the permitting fees and the construction cost overruns. It's just a nightmare building one or two new nuclear power plants here in the U.S. So the growth is mostly going to come from outside the U.S. in developing countries. I think Saudi Arabia is building a good amount of new nuclear power plants over the next 10 or 15 years because they want to diversify their type of electricity away. And then China is building a lot. Although China is still, and I just saw this data, in 2022, China permitted 2 new coal-fired power plants per week. So that's probably why Einhorn is buying coal stocks right now.
Let's face it, China, they pay lip service to the environment, but they just do whatever they can make money with.
And this is important with analyzing the behavior of governments, because it's not what governments say, it's what they actually do. So China is running all of these green energy commercials. they're going to Davos and talking about, oh, we're going to have the most electric vehicle fleet. We're going to invest in wind and solar. They're leaving out like all how their environment is destroyed from rare earth mining, irresponsible rare earth mining that's not environmentally friendly. They're skipping a ton of steps. And then also that they're building all these coal-fired power plants each week still.
Speaking of China, do you have any thoughts on their real estate market? I mean, I know
it's a bust.
It's been a total disaster. I don't know whether
so
it's getting worse or do you think it's getting better?
So there's no strategic defaults allowed for residential real estate in China. So people will prepay their mortgage if they have the savings and cash flow to do so. But their mortgages. A lot of people in China are upside down if they used a mortgage. And people in China, there's rumors, like I said, of the yuan has been weak against the dollar, and there's rumors that there may be additional devaluation of the yuan against the dollar. And so if you're a regular Chinese person, you're not super rich, you're not a Chinese Communist Party elite, or you're not a billionaire, the regular Chinese person that's either middle class, upper middle class, maybe owns a successful small business, but isn't super elite wealthy, they're going to probably buy more physical gold. And we've seen that with the numbers. So that's probably helping keep physical gold demand strong. Also, central bank gold purchases for physical gold are still pretty strong. I know people were throwing that Turkey number around, but it's more how Turkey sold a certain amount of gold, but it's more complicated than that because I think the Turkish central bank had to sell some gold to the private sector. Also, they don't want to import as much physical gold because like the Turkish government is super corrupt. So the Turkish citizens, there's like capital controls, I think similar to China. So you don't want to save in Turkish lira, just like a lot of other emerging market currencies. So I think a lot of people in Turkey are buying like Bitcoin, cryptocurrency, and physical gold.
I was going to say, I'm sure they're buying precious metals. And I mean, this has happened. Turkey's had crashes in their currency several times, and from my recollection. So
the rich people inside Turkey that either are connected to the government or own the government or running the government, they do not save in their domestic currency. So they borrow debt.
Why would you?
So they borrow debt in the domestic currency, and that debt is devalued, but they're investing, they're getting their savings and their wealth out of the country. They may use debt inside the country, but they have a lot of diversification and they have investments in other currencies that are safer.
Yeah, it's a sensible thing to do. I mean, I'm hoping some average people do the same thing in that country, as well as our country. So. Is there anything else you wanted to cover, Jason?
Maybe with the debt ceiling and the Fed reversing. So I think we'd have to see for the Fed to reverse. I think we'd have to see for them to actually like start considering cutting rates, because officially they're not considering cutting rates at all in 2023. We'd have to see more bank failures.
I'm sure.
Or a crash. We'd have to see a legitimate crash in the stock market or other asset prices, and then large scale bank failures. So not just one Silicon Valley Bank or First Republic Bank. We'd have to see a chain of these things just start to like dominoes falling.
And I think that's going to happen. It's kind of questionable in my mind if they're actually going to be raising rates, come September or October, when everything kind of starts heading. We have the student loan thing we've talked about. But let's face the debt limit. It's been such a joke. I mean, we never had a doubt that they were going to raise it.
Both political parties are fighting over spending increases. They're not fighting over real decreases. So
they're definitely not. So
even the Republicans, the MAGA guys that the Democrats were blaming in the mainstream media about like they're stingy, they want to cut spending, they want to starve women and children, and shove elderly out and hurt them financially and ruin them financially, so they don't have access to any of this. I mean, even the MAGA Republicans, I think, agreed to near unlimited spending cap prior to the next election. So,
and there's such a fiscal gap now in the government. In order to reach fulfill all the promised entitlements to everyone, it would be 7.7% of the GDP. And that would mean that they'd have to raise all taxes 40% to cover that, or cut spending by like 36% altogether.
Are you citing the presentations that Stanley Druckenmiller has been doing the last month or so?
I am. Yep, I am.
Yeah, those are really good. I recommend those. So in the short term, In the short term, that's not going to affect markets, but he's just talking about how government spending and social program spending
Out
are
of control.
crowding out the private sector.
Yep.
And basically, as I've been saying now for weeks now, with interviews and other stuff publicly, you have 4 expenses for the US federal government, and they're just absolutely massive. The one expense the government was not counting on is interest payments on debt.
And they created it, so they should have known about it and anticipated it.
Well, but they have to fight inflation, though, even though raising interest rates doesn't really fight inflation, because then it's going to create long-term supply problems, because then businesses have to pay back debt and they're not going to make investments in new commodity supply or property, plant, and equipment and all these things that need to be invested in.
It's the giant fallacy that central planning works in any situation. And it doesn't, clearly.
But Lee, even if the Fed doesn't raise interest rates anymore the rest of the year, I think the damage is already done. From speaking with that banker, researching this, listening to other banking experts, I think the damage with the banking system is absolutely immense. Even if the Fed started rapidly cutting rates, I think a lot of the banks still have immense problems. We're just in the first inning of the commercial real estate crisis, even though every day you're going to see just negative headline, negative headline, negative headline. It is definitely reminiscent of 2005, 2006, 2007, except this cycle is the major problems are not residential real estate. The major problems are commercial real estate.
Jason, I am going to make a very bold prediction. Within the next few years, JP Morgan's going to own more former bank assets.
Oh, and the FDIC and the U.S. federal government and the taxpayer are going to subsidize everything, of course.
Absolutely, yes.
It's just asset stripping. I mean, the Federal Reserve Bank just does whatever. They protect the 5 or 6 largest banks that own the majority of the shares. So your Bank of America, your JP Morgan, Wells Fargo, Goldman Sachs, Citigroup. Citigroup was leveraged. Most people either aren't aware of this or forget. In 2008, when things were at their worst, Citigroup was leveraged. Their balance sheet, Citigroup was insolvent. The accounting rules were changed by March of 2009. The FASB changed the mark-to-market accounting rules. A lot of it was because of Citigroup, because they were leveraged 100 to 1. Citigroup was insolvent, and all these things were meant to save the larger banks. And now here we are, the larger banks, they're going to go from too big to fail to even larger too big to fails.
There's an interesting phenomenon that's happened, and cryptocurrency certainly accelerated this. 20 plus years ago, when I used to follow all the finance stuff, very, very few people were aware of the Federal Reserve and what was going on. But with all the education with crypto, people are becoming more and more aware of the scam. And I just got an update in YouTube, and Tim Pool is even having a Federal Reserve update. So,
well, Lee, a few decades ago, if you go back and look at tax receipts for the U.S. federal government and all these levels of government, they were not nearly as dependent on higher asset prices, property taxes, capital gains taxes on stocks, bonds, real estate. The tax receipts that were coming in from the U.S. federal government were reliant on actual businesses growing.
Yeah.
So the consumer going out to eat at restaurants or shopping, spending money, businesses investing in property, plant, equipment, growing their businesses, paying corporate income tax. The tax receipts were more dependent on that. The Alan Greenspan Fed really started to transition this away because they were in a bond bull market and interest rates were going lower. And they decided, rather than raising taxes directly, they started, we'll just in a bond bull market where interest rates are going lower, we'll just focus on inflating asset prices and keeping taxes, either lowering taxes or keeping taxes at low levels, and then taxing asset prices more on the monetary inflation that via the Cantillon effect that inflated stocks, bonds, and real estate to artificially high levels. So that's what has changed in the last 2 or 3 decades compared to the past. We now have a situation, I think, where the U.S. Treasury, the tax receipts, it's up to around 30%, might be a little higher, 30% give or take the last time I looked at it, where tax receipts are based on capital gains taxes on stocks, bonds, real estate. At the state and local governmentally, the budgets are super dependent, and this has changed a lot in decades too, on property tax revenues. Those things, you speak to certain cities and states and municipalities and just hear about the absolutely horrible stories of, even in a recession or depression, problems in the local economy, and the politicians, the bureaucrats in the local government still want to raise property taxes astronomically every few years.
It's it's one giant scam, isn't it?
Well, this fits very neatly under stagflation, tax lie, and the
Yep.
Cantillon effect.
Yep.
And the governments and central banks have gotten away with it for a very, very long time. Can this continue? I would argue that the entire global financial system is and fractional reserve banking, debt-based fiat currencies, unsustainable. I have no idea exactly what the next system is. I have no idea how long
You
that
have
they
no
can
idea.
keep.
Come on, we all know it's going to be CBDC and direct control.
But there's a huge fight back. Look at the polling that most Americans are aware of this now. When I go out to a party and ask about central bank digital currencies, I hear people saying, "I've researched this and I hate it. I don't want anything to do with it." So it's going to have to be forced on us, similar to the Chinese Communist Party or the China model.
Right. Which is what I think they're intending to do. I mean, they'll create some crisis, and that will be the only solution that they will have, and the crisis will be painful.
So
That's
what
the
is
only
the
way
is
they're
the
going to be able to do it.
so what is the old Benjamin Franklin quote? They're going to try to put a gun to the proverbial financial gun to our head and tell us we can either have security or freedom and make us choose.
Yeah, pretty much.
But then we don't really have security. It's a false sense of security, and they've lied to us again.
But you know what? When you're starving and you have to feed your kids, you'll probably agree to pretty much anything. So they'll make us an offer that we can't refuse.
Or we end up morally bankrupt like the Roman Empire or Weimar Republic Germany prior to their prior to or during their hyperinflation.
So, I mean, there's a battle between awareness and action right now, and it's interesting to see it play out every day. And it's not just the economy; it's obviously in the political circles as well.
But these higher interest rates are not sustainable. The total debt in the system is not sustainable. There's going to have to be another system. It's not just I've been interviewing all these experts now for weeks. It's not as simple to de-dollarize as these YouTube videos and these other people claim. Go back and look at their track records predicting de-dollarization for the last 10 or 15 years.
Yep.
And whether it was the petro yuan, the gold-backed petro yuan, the crypto gold-backed petro yuan, I think Max Kaiser used to make a new de-dollarization prediction with a new type of system every like 6 to 12 months. The dude made like an insane amount of money speculating on Bitcoin, but all Peter Schiff, Max Kaiser, Luke Roman, all of their de-dollarization predictions the last 10 or 15 years have just been way, way wrong.
They've just fallen flat for sure. No doubt about it.
Well, I'm not saying it won't happen. I'm just saying that people have been predicting that'll happen rapidly for the last 10 or 15 years. The system, the current system we have now with the euro dollar, over-the-counter derivatives, global trade, cross-border global trade settled in dollars, the SWIFT payment system between banks, all these, how when the dollar gets weakly, all these foreign governments and foreign corporations, they say publicly, oh, we're going to de-dollarize. Oh, we hate the US, right? Well, their actions are the opposite of what they say in public because they actually borrow more dollars.
You know, to some extent, it's the mentality of value investing, where you look for the logical investment. Let me finish my thought. You look for the most logical investment to make based on the numbers. But the problem is that it doesn't happen overnight. Sometimes these things take far longer than you anticipate them to happen.
Well, I would say it shorts. Are you talking about like the foreign governments and foreign corporations that like they say publicly that we're going to de-dollarize and we hate the U.S. government and we hate the Federal Reserve Bank, and then with their actions they go and borrow more dollar denominated debt?
What I'm saying is like the conditions are there that it makes sense that it should happen at some point. So like you can position yourself for it, but the problem is it could happen in 20 years. So you just never know how long it's going to take.
Yeah, I'm not in the business of trying to predict when that's going to happen.
Right, but you understand what I'm saying.
My YouTube channel, if I actually did those clickbait videos with de-dollarization, my YouTube channel would probably be 2 or 3 times the size it is now.
I'm sure it would. Sensationalism sells. So, but you understand what I'm saying, right? Like things just develop over such long time frames that you can't predict things like it's going to happen tomorrow. You know, like
the system that was set up, was made so these countries would be dollar dependent, and these countries did have options to distance themselves from the dollar, but that would involve not looking at the short term and not borrowing more dollar denominated debt. So if these countries were actually serious about de-dollarizing, they would focus on commodities. They would focus on accumulating more gold reserves. We've only seen these central banks really accumulate more physical gold tonnage in the last, really since November 2022. Now there is a
Right,
trend.
right.
The big increases started this past November, but a lot of other central banks were not. I mean, for years they have not. Only China and a few others were really buying a lot of physical gold in the past. Now more of them are starting.
And recently we've seen a more robust BRICS nations exerting their will into the world economy, which has definitely been a seed change.
Well, let's see if the dollar does get weak. So if the Fed cuts rates again and the Fed starts expanding the balance sheet again, the Fed does new liquidity programs or bank balance or QE, let's see the actions rather than the bullshit press releases and the bullshit words from these foreign governments and foreign central banks. Let's see if they actually increase dollar denominated debt.
Yeah,
so if they're saying one thing, and this is why at this point, I mean, honestly, I don't trust any government or any central bank. They all to different degrees do lie, spin, propaganda, economic propaganda.
of course. Yep.
But if they're talking in public about de-dollarization, and then the dollar gets weak again, the Fed does more bank bailouts, and the balance sheet does a full one. Fed's official balance sheet does a full 180, and we're looking at I don't know, 15 trillion on the Fed's balance sheet in a rapid amount of time, because the next crisis I think will probably be larger than the past ones. We'll see if those other foreign governments and foreign central banks stick to their guns about de-dollarization, or they actually borrow more dollar-denominated debt. So that will tell the tale if they're actually serious about de-dollarizing or not.
Well, I guess time will tell, Jason, as they say. So,
well, as for regular investors out there, you don't need to time this. You don't need to bet on one outcome or timing perfectly. And this is where you can have some diversification. The people that are all in on Bitcoin or all in on gold and silver, very dangerous environment to be all in on any one asset class, where the government can change the tax rules or grandfather clause or ex post facto, which means changing after the fact. They could put some type of retroactive clause in there.
that's true. They can pretty much do anything. So diversification is a very important thing to have.
Well, I keep seeing posts from people saying that they don't trust gold and silver anymore. They don't want to buy gold and silver. It's a waste. Anyone who says anything nice about it's a moron. They're just going to buy Bitcoin and crypto. Well, look, all the crypto exchanges, red flags across the board.
Oh man, that would be the last place I'd want to be.
Well, and I'm not saying not to own any Bitcoin, but there's a ton of people that are all in Bitcoin, especially younger adults or other speculators. And then
they've been doing that. They've been saying that for years, Jason. I mean, it's ever since I've been following the crypto space. Gold and silver's dead. Crypto's the new thing.
Well, did you see the new one with Tether that came out? So there was a Bloomberg investigative journalist report, and they finally found in disclosures and whistleblowers and stuff with Tether that Tether has been lying about the stuff that they're making the stable coin with, and they were buying a bunch of really junky Chinese debt. So they were denying it.
Yeah, once backed by Chinese securities, yes. But it said as of July 2022 that they have no Chinese stocks at this point, so we'll see.
Yeah, so as we wrap up here, Lee, for episode 21 of Finance Unspun, I think the things to watch out for are that I think we're setting up towards September, so after Labor Day, September, October timeframe, potential huge crash in a lot of asset prices, stock market, and that's whether the Fed raises interest rates or not. So if the Fed raises interest rates, I think it's only going to accelerate things, problems with commercial real estate and the banks, potentially other publicly traded companies that have too much debt on the balance sheet and have their cash flows collapsing. Maybe the consumer cut back, and so the cash flows that they were projecting to service their debt on their balance sheet are paid off. Those cash flows are not there.
And while you say that, it doesn't mean that the market can't climb from here. You know, markets go way past where you expect them to in both directions, and we've been rallying. So I would not be surprised to see it bounce a little bit more higher. But I agree with you. Come summer and fall, it could get very ugly very quickly.
Well, the rich Wall Street hedge fund guys that are at the Hamptons, or they're in the Mediterranean, Europe on their yacht or partying or whatever, those guys are going to come back to their desks and they're going to look at a lot of the fundamentals, and they're not going to like the stuff that they're seeing.
Yeah, no doubt about it.
And this is historically why we've had a lot of crashes. For listeners out there in seasonality, this is historically why in U.S. capital markets, the stock market, we've had a lot of crashes in September and October.
Mm-hmm. Makes perfect sense. It's been going on. I mean, people vacation in the summer, and they've always been doing that. So All right, Jason. It's been a great episode. Always a good time to talk to you. Appreciate it.